Hey, welcome back. It's Jason Walter here. In today's video, I'm going to be discussing the future of the 2021 housing market. So if you're looking to buy a house this year, maybe you're looking to sell a house, or you're just interested in what's going on in the real estate market today, then this video is for you. And I'm really excited to share this video with you. So if you are too, please hit the like button and also subscribe if you haven't done so already. And let's go ahead and dive right into the video. Our real estate market is tied to two main factors, and that is housing inventory and interest rates. What has caused the real estate market to absolutely surge since last summer is record low interest rates and also record low inventory. For example, mortgage interest rates are slightly above record low levels right now. So according to Freddie Mac yesterday, the average 30-year fixed rate mortgage is only 2.73%. A year ago at this time, rates averaged 3.45%. What this means for home buyers is a savings of around $100 per month for a $300,000 loan. However, I think many would agree that rising home prices has more or less negated the fact that we have record low interest rates right now. Active listing inventory in the US has absolutely nosedived in recent years here. So 1 year ago, there were just over 1 million houses listed for sale. And last month, in January 2021, there was 598,000. That equates to about a 40% drop of active listings in the US. When you compare that to July 2016, there was a whopping 1.6 million homes listed for sale, which is more than 2.5 times what we have right now. And according to data analytics firm Black Knight, the number of existing homes for sale is at its lowest level in more than 20 years. And Black Knight reports that one of the main reasons for this is an insufficient amount of new homes being built relative to our growing population in the United States. As you can see in this graphic here, new housing starts have increased since the Great Recession, but we're currently only slightly above the averages of the previous cycles. To make matters worse, home builder confidence has decreased recently. The National Association of Home Builders chairman stated the following: despite robust housing demand and low mortgage rates, buyers are facing a dearth of new homes on the market, which is exacerbating affordability problems. Builders are grappling with supply-side constraints related to lumber and other material costs, a lack of affordable lots, and labor shortages that delay delivery times and put upward pressure on home prices. They are also concerned about a changing regulatory environment. For example, after taking a more recent dip, lumber prices are approaching record highs again. Lumber has more than doubled in price over the last 7 months. And you guessed it, these rising lumber costs and material costs is ultimately passed down to home buyers, which is causing home prices for new houses to increase. Therefore, the inventory for brand new houses has decreased significantly due to these factors. So the burden of our housing inventory right now rests with existing homes being listed, but we're not seeing a big increase just yet. However, housing inventory tends to peak in the spring and summer months, and at the time of this video, it's only February, so stay tuned on the channel for new developments on that. So because there's record low interest rates and also record low inventory, that has caused home prices to increase significantly in the US. That's great news if you're a home seller, but not so much if you're a home buyer. For the most recent data that we have, home prices in the US went up 13% compared to 1 year ago, and home prices in California are up a staggering 16.8% to a new record high. And despite a global pandemic, home prices in California reached record highs 5 times in 2020. So obviously our real estate market in the US is absolutely surging right now, which is great for home sellers, not so much for home buyers. So hopefully new inventory will be hitting the market soon. However, here's what I found very troubling here, because I found a recent report by Black Knight that was just published a few days ago. Black Knight reports mortgage forbearance numbers on a weekly basis. They're a great website if you want to learn more about mortgage loan forbearances. I also have made a ton of videos about forbearance as well. But if you're not familiar with what a mortgage forbearance is, it basically allows qualified homeowners to basically raise their hand, call their loan servicer and say, hey, I have a financial hardship due to COVID-19. I want to enter into a forbearance plan that allows homeowners to stop paying their mortgages for up to 12 months. And that was thanks to the CARES Act that was passed in late March of last year. In any case, Black Knight reports that nearly a quarter of all forbearance plans will come to an end on March 31st. That represents about 600,000 homeowners who will have reached their 12-month forbearance mark. The big question mark is, what will these homeowners do when they exit their forbearance plan? If you have a federally backed mortgage, meaning you have a mortgage that's backed by the FHA, the VA, or the USDA, you have a lot of options when to exit your mortgage loan forbearance plan because those are protected by the CARES Act. If you watched my video from a few days ago, you know that the Mortgage Bankers Association, or the MBA, reported that for the forbearance exits from June 1st, 2020 through January 24th, 2021, 28.6% continued to make their monthly payments during their forbearance period. However, Black Knight reports some more troubling news because they stated the following. While early in this pandemic, roughly half of the homeowners in forbearance continued to make their monthly mortgage payments, that number has steadily declined. Today, it's about 12%, which suggests that people who are taking the full forbearance period afforded to them, which is of course 12 months, may well be experiencing prolonged financial distress and face extended challenges as they return to making their mortgage payments. And of course, remember, just because you get permission to stop paying your mortgage for up to 12 months, this does not mean that these payments are going to be forgiven. You do have to pay them back eventually. And right now, there's about 2.7 million homeowners who are currently in forbearance. Now, I'm not saying this is going to be causing a foreclosure tsunami, but here's something very, very important to keep an eye out for. Due to rising home prices over the last several years, home equity has risen to record levels. In fact, only 10.4% of homeowners in forbearance have less than 10% equity in their houses. That's nearly 290,000 people. So about 90% have more than 10% equity in their houses, which in general allows people to sell their houses after paying closing costs. This is obviously great news for homeowners who are in forbearance who still do not have a job and will not have the ability to start paying their mortgage after their 12-month forbearance period ends. However, here's something to take a look at because this is super important and something you definitely want to be aware of. Okay, so about 10% of all homeowners have less than 10% equity in their houses. However, add in the effect of 12 months of deferred interest during the forbearance period, and the share swells from 10.4% to 15.3%, or some 425,000 homeowners who would have less than 10% equity in their houses. This doesn't even take into consideration any deferred taxes or insurance, which could further impact a borrower's equity position. What's even more concerning about this report is those who have an FHA or a VA loan. So if you recall, you can buy a house with a VA loan with 0% down, or with an FHA, you can buy a house with 3.5% down. So when these people buy a house, they automatically have a small amount of equity in their houses, especially when you compare that to someone who's buying a house with 20% down. So here's the big kicker here, because Black Knight reports that nearly 20% of FHA or VA mortgages in forbearance have less than 10% equity, although that rises to more than a quarter or 26% when adding in their deferred interest. The big question mark will be, of course, will these VA and FHA homeowners, will these cause foreclosures, and will inventory increase as they exit their forbearance plans? Time will tell, but I'd love to know your thoughts about this, so comment below with your predictions. This is going to be very interesting to see how 2021 plays out. So if you appreciate real estate market updates just like this one, please hit the like button and also consider subscribing if you haven't done so already. I post videos about how this pandemic is affecting our real estate market, and I really enjoy making these videos for you. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day and look forward to seeing you on the next video.